Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, have you accumulated too many funds in your portfolio? Do you want to trim your portfolio but are wary of the 12.5% long-term capital gains tax? Well, if so, then today's session is for you. In today's episode, we'll try and learn from Dhirendra Kumar how to make smart decisions and optimize our portfolio with the help of value research tools. So, Dhirendra, first up, how to assess your current portfolio? Are there any tools on value research that can help?
Oh yes,
users?
value research online. I think that's the most used and most admired or most useful tool, which is set up your portfolio, import your portfolio, and it does everything seamlessly, flawlessly, and it gives you insight on your own portfolio. It helps you discover things which you don't know what you actually own. Because most of us in the course of our investing life, we are not investors, we are collectors. We keep collecting something here, something there, and most of the time initial 5, 7, 10 years, because of the state of literacy about financial affairs, because of our lack of understanding. Also because savings and investment is hard, because most of the time we are busy spending or busy earning. Here you can take care of your equity, your mutual funds, your NPS, your public provident fund, or any bond that you may have. Not only this, you can have it for the whole family in a single account. So tracking all your family's financial affairs at one place, Value Research Portfolio Manager is the place. What it does much more than just keeping track of things. One is that it helps you figure out what exactly is going on with your money. Most people look at it that I have these many mutual funds. Whether it is a debt fund, whether it is an equity fund. So it is able to dissect across anything that you may have, including NPS, and tells you that how much of your money is in equity, how much of your money is in debt, and how much of your money is in non-equity and debt, so to say, commodities or gold or a gold fund or a sovereign gold bonds. And this way you gain clarity in terms of where do you stand, because many times people have will have 5% of their money in equity and equity funds, and they'll be worried 95% of the time, and they will have 95% of their money somewhere about which they can't do anything about, and it is not going to make him wealthy, but it gets him disproportionate worry. So Value Research Online Portfolio Manager is the place which not only tells you how your things add up, it also tells you what you should delete from your portfolio, what you should not have, and why. Because it is able to give you an update on all the stocks that you have, why one should sell it, why one should not have it, what are the kind of funds you should not have. So it goes much beyond that, and I think it's for anybody thoughtful about his investment. I think Value Research Portfolio Manager is an essential activity which one should be in, and it takes very little time.
All right, that's about assessing the portfolio. But once you've assessed it, once you know that, say, you have some 20 funds in your portfolio or a number of stocks, but you need to, the portfolio planner suggests that you need to cut down on the number of funds. How does one do that? Because now the worry is that there is this 12.5% long-term capital gains tax also to be taken into account. So how does one go about it?
One is that to follow the value research way. We keep telling you time and again that have few funds, keep it simple. And to keep it simple, you need to do a couple of things. And earlier also it was important. Now it has become all the more important. Because earlier, the tax incidence was not as much. Like, assuming that you have to invest in debt and you have to invest in equity. You invest in an equity fund and you invest in a debt fund to the extent you want to, say 75% into equity, 25% into debt. As compared to that, you invest in an aggressive hybrid fund. If you invest in an equity and debt separately, whenever you sell equity to move money to debt or sell debt to move money to equity, there will be a tax incidence. Tax incidence which has become even more severe. And for debt, it has become all the more difficult, because now, earlier, with a 3-year holding period and indexation, it made sense. Today, it has become virtually unattractive, because on debt, you will get 7-8% at most. And if on top of that, you happen to be in the 30% tax bracket, it's over. You will earn 5%. 30% of that is gone. So it doesn't make sense. So By putting money in an aggressive hybrid fund, you are not liable to pay taxes because the fund manager is making all these changes. So there are multiple levels at which you have to understand that if you are investing in stocks and you are a hyperactive buyer and seller, stop doing that, invest in a mutual fund. Because if you do that, you earn 10% more than a fund manager, you will actually break even, because in a mutual fund, he will not pay taxes. So by buying and selling, assuming that you are as good as a fund manager and you are buying and selling and generating 10% more, then you will actually match the fund manager, because for him it is tax exempt. Fund manager is buying and selling, generating short-term capital gains, generating long-term capital gains, but till you take your money out, you are not liable for that. So mutual fund has become a superior vehicle. Asset allocation is taken care of in all the hybrids. Moving money from equity to debt, debt to equity is taken care of. Then, and to do this, to be able to, there is a great value of making an investment which you don't have to sell till you need the money. Because if you can hold it for 5 years, 10 years, 15 years, 20 years, nothing like it. Because the moment you take your money out to move it to some other investment, 10% of your, now earlier 10%, now 12.5% of your gains is gone. So you are actually resetting downward all the time. You have to find a way out, and the way is very simple. Choose a fund carefully. Keep as few as possible. Make sure that your vehicles are as diversified as possible. And resist the temptation to invest in fashionable things. And that is it. If you do these 3-4 things, you'll be better, you'll be sorted, you'll be better prepared for, or you will not it will not have as much of an impact.
For someone starting out now, that sounds feasible. But if someone already has some 40 funds in his portfolio and he wants to cut down, what about the tax incidence there? Is there anything that the person can do about it?
Yeah, you can do something about it. One is that set up your portfolio on Value Search Online. Figure out that, are those funds good? If you have 25 funds, and of the 25 funds, 22 are good. So keep holding them. Don't try to reduce it just because I'm saying that you should have 4. Because most important thing is to have good funds. Then if you have bad funds, get rid of it. But reduce your holdings. But don't reduce just for the sake of reduction. Because it is very difficult to predict that which one will do better over a period of time. Yeah, from here on, don't add too many. Try and look for the funds which you already have and put more money in that. Put more money in the best of the fund that you have. And this funds which are good, funds which are exceptional, funds which are bad, funds which are avoidable, these are things which you get marked in the portfolio manager at Value Search. Set up your portfolio, you will figure out which one to sell, which one to sell urgently. Because there are 2 ways of looking at it. One is that, if many a times when you use the Value Search portfolio builder, it tells you 4 funds to invest. But if you already have 8 of them or 10 of them, that does not necessarily mean sell. Our idea of recommendation is that 4 is good enough. But if you already have 10 of them and they are all good funds, you don't need to sell just because, the tax bill will reduce the worth of that capital. Only when they justify being sold, they are questionable fund, sell them by all means. So be more objective about it, and don't be scared of holding more funds just because you have too many. Most important thing is that they should be good funds.
So now that tax bill has gone up, things have been simplified, but so how can an investor, work around his way?
We have been telling it for years, and now it has become all the more important. One is to actually think long term when it comes to equity. Because not thinking long term, which means you'll buy it for the short term, then sell it. Even if you succeed, you sell it and then pay taxes. If it is short term, you pay more. If it is long term, you pay little less, but still you pay quite meaningful amount, 1/10 or 12.5% of it is gone. If it is short term, you pay 20%. So think long term, that's one. Keep it diversified. So there is the case for mutual fund as a diversified vehicle, which you can hold for 5 years, 10 years, 15, 20 years, while it is managed internally, but you are not liable to pay taxes because you have held it. Consider hybrid fund if you are going to be a asset allocator. If you want to be conservative, then choose those funds, because even asset allocation, moving money from equity and debt, will not be taxed as much. Third is that, there is a small trick that you can apply, that you are investing for the long run. But sometime in between, prices go down and you're sitting on losses. But you intend to hold it for 10 years, 5 years, whatever. Sell those securities and buy them again. The advantage of this is that you have now created notional loss in your book. You bought something at 120. The price came down to 100 rupees. You sold it and you bought it again. Now your new purchase price is 100 rupees. And so nothing has changed in your portfolio. You had 100 shares of a company, now also you have 100 shares of a company, but you have created 20 rupee of losses because now that was the notional loss that you incurred. Now this 20 rupee loss that you have created for yourself in your accounting books, this can offset any gains that you might have. And so if you have in your long-term journey, you have interim periods when you are sitting on losses, book those losses, buy those securities again, so that it can offset any of the gains. If in next 1 or 2 years you sell something and you have this 20 rupees gain, you don't have to pay taxes on that. So that is called tax harvesting. The third and the final one is not tax harvesting, but the government has also increased from this year your exempt capital gains amount. Earlier it was 1 lakh rupees. Now it has gone up to 1,25,000 rupees. So, and many years you don't sell anything. So it will be desirable, though it is not going to make a huge difference in the very long run. But still, if you are sitting on a gain of 1,25,000 rupee in multiple investments in the month of March, sell those ones and realize that money, maybe invest that money again. Because 1,25,000 rupee is a tax exempt every year. So if you let it lapse, and that is an entitlement which is you are entitled to every year after year. So if you sell something and have gains of 1,25,000 rupees, no taxes, and you buy those shares again, your price actually, your acquisition price gets reset. So from here on, it will increase, and that will be liable for taxes again next year. So over the next 10 years, in the long run for which you are investing, you can actually take 1,25,000 rupees credit by selling and buying again over the next 10 years. So that is like 12.5 lakh rupees of gains, which you have realized, on which you don't have to pay taxes if you are methodical about it.
So are you suggesting that every year one should sell if the gain is
1 lakh, up to 1 lakh rupees 25,000 rupees, you have 5 lakh rupees gain, but sell to the extent that 1 lakh 25,000 rupees you have realized and put again.
Okay. All right. And then what about NPS? Isn't that an attractive option as well?
Very attractive from this taxation point of view. If you invest 5 lakh rupees in, take your money in the NPS, in the tier 2 account, you invest in an equity fund and a part of it in debt fund. And you keep moving your money from equity to debt, from one fund to another. And till you don't take money out of the NPS account, it is all tax exempt. Even moving from equity to debt. So asset allocation wise, NPS is almost like a mutual fund, except that, it is not called one.
And so NPS tier 2, we're talking about.
NPS tier 2.
Right.
Because tier 1, once you move, you can move your money in tier 1 as well, but you can't take money out of tier 1. In tier 2, you can move as much money as you want to. Keep moving your money from one fund to another, from equity to debt, and it doesn't matter. Till you don't take your money out, you're not liable for any taxes. So from that standpoint, from changing allocation, of course, NPS does not offer you that variety. But we keep telling that you don't need the variety. You need lower expense, you need diversification, and you need asset allocation. And I think NPS has become more attractive vehicle as a result of this.
All right, then that's how you can sharpen your portfolio post this budget. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.